I'm Matt Schwegman. I'm a fee-only advisor here in Fall Creek. We opened up about 2 years ago. I've been working on building my client base, and we started having these monthly meetings to just, give the neighborhood some general information about pertinent financial planning and investment management topics. So we'll just jump into it. Today we're going to talk about retirement withdrawal considerations. Again, I'm Matt Schwegman. You can reach me at info@Compose Financial if you have any questions. And my number is 281-705-7161. First, we're going to talk about a little bit of disclosures, the fun stuff. So I don't know your personal situation, right? So these are all just very general. They might not apply to you. You might have some specific situations that just don't make, just some of this general information might not make sense to you. All the information we have taken from our sources in the back, we believe to be reliable as of this date, might change in the future. So it's always best, if you're looking back at your stuff a year from now, you might want to make sure it's updated. All right, so today we're going to talk about the order of retirement withdrawals. We're going to first our focus at my firm is to try to lower investment fees and taxes, the two things that are going to be hit with. Those are only two guarantees in the financial world, taxes and fees. So what we try to do here is lower both of those. So we're trying to determine which of these three different accounts, taxable, tax-deferred, or tax-free, is the best to withdraw from first in order to minimize taxes over the long run. So taxable account, of course, is taxable today. Tax-deferred is you're going to be taxed when you withdraw it sometime in the future. And tax-free is like your Roth accounts, 401ks or IRAs. You've already paid tax on them. You're never taxed again. We'll also talk about at the end how your specific goals and circumstances could change these recommendations. And our conclusion will be, you'll see, is to diversify the tax status of your accounts, not just your investments. Diversification is always talked about, and it's important on two aspects in this. Not just your investments and investing in different asset classes, but also the accounts, the types of accounts, taxable, tax-deferred, or tax-free.
Why would you do taxable?
I'm sorry?
Why would you do taxable then?
Taxable is the most common one. You're only allowed to contribute to the other two types of accounts in very specific situations for retirement or like with your employer, and tax-free is hard to contribute to because there's the IRS sets income limits. So if you make over a certain amount, it's harder to contribute to tax-free accounts. So generally, especially if you get into higher incomes, you're going to be more on the taxable side. And we'll get into some of that. That's a good question. We're going to get into some of that at the end because as you'll see on this slide, well, it's going to be general rule number 2. But the first general rule is so from your tax-deferred accounts, you have required minimum distributions. If you don't withdraw as much as you should, you're going to be hit with a 50% tax. That, of course, is never good. So the first rule always is to take out your required minimum.
And they will tell you what your required minimum is?
It's a formula by the IRS. So you'll get there's a schedule, and it's a percent of your account balance as of December 31st is what you have to take out for the next year.
I would retire like at 66?
You can. This is just a required minimum. You have to start, because you haven't been taxed, the IRS wants your money sometime, right? So they're going to make you take it out eventually. That's what that's for.
Okay.
Because you'll see in the next slide, our general rule number 2 is that you want to take taxable first. And this is why required minimum distributions came into play, is because everyone else figured this out too. You'll want to extend that tax-deferred and tax-free growth as long as possible. So you'll want to be hit with taxes up front generally on your taxable accounts because you're going to have to pay those anyways. So you might as well pay those now and again, maximize the exponential growth of your tax-free gains and tax-deferred gains. So taxable first, and we'll talk about this. This is one of the big rules that, depending on your situation, might not be right. So we'll get into that later. But this is exactly why the IRS set up required minimum distributions, because everyone would just take from taxable, never take from their tax deferred, and they'd never get their money back. They want the tax on your accounts. They're just giving you an incentive to save for retirement.
And then if you should die during this period, then give it to your kids. Do they have to start all over again on tax?
There's a bunch of different, depending on who inherits it, there's different rules on how they have to withdraw it. So, like if a son inherited, a mom's past her account, they have the option of either taking over their life expectancy. They can do like a 5-year withdrawal plan. There's a couple, it gets a little complicated, and I can send you that if you want, but there's different rules on who inherits it, what your options are.
Okay.
And in some options you can take a lump sum, you can take it all and pay tax immediately. Generally not the best idea. Generally you'll want to spread it over your life expectancy. Again, to minimize taxes and defer it as long as possible. Another reason why you want to do taxable first is on your taxable accounts, you have the chance for capital gain tax rates. So if you took from a deferred account, you're going to pay ordinary income tax. Oh, and skipped over number 2 here. You're only paying on the capital appreciation. So when you take out a withdrawal from your tax deferred accounts, if you take out 50 grand, you're paying tax on the entire 50 grand. If you take 50 grand out of a taxable account and you had a basis of 10 grand, you're only paying tax on the 40, right? You're only paying tax on the gain. So that's another reason why you'd want to do this first. So then now we're getting to 3A and 3B. So we've already exhausted our taxable account, and now we have left over our tax deferred and tax free. So generally, and this is kind of logical too, if you know your taxes are going to be higher in the today, if you know your tax is going to be higher in the future, you want to do tax deferred and then tax free obviously later when those high tax rates come into play. So you're minimizing your taxes. Conversely, if your tax rate's high today, going to be lower in the future, you'll want to take your tax free today, tax deferred in the future. And so a lot of people automatically assume, who I've talked to, the general consensus seems to be that my taxes have gone up, everything's going to be higher in the future, the country's going to hell. But as you can see from this slide, the effective income tax rate from 1982 to 2011, if you look at the green line, so this is by quintile, so it's every 20%. So the green line is the average of all of them. And it went from 21% back in 1982 to 18% in 2011. So it's gone down over the last 20 years, is the point here. So this is why, even though you might assume, stuff is, and this doesn't include, right, you're only paying income taxes. Doesn't include other taxes you're going to pay, property taxes, all those other taxes probably have gone up, but we're only focusing on income taxes here because that's what's going to hit your retirement portfolio. So the income tax rate has gone down. This is from the Tax Policy Center. So the general rule number 4 is to really utilize what we call the retirement wild card. It's the tax-free accounts. They're the most versatile of all the 3 accounts. So if you're proactive, let's say, if you're proactive, you can manage your withdrawals to fall within favorable tax brackets. So for example, let's say you've just entered retirement, your whole life you wanted a new addition to your house. So you're going to need money today. You're going to be in a higher tax bracket in this one particular year because you need a big withdrawal than you're going to have in the future. Every other year after this, not like you're going to do an addition necessarily. You're going to spend some huge amount this year. It might make sense to use the tax-free accounts for this year. Does that make sense? And this again this is pretty proactive. This is where you get into some of the kind of, you're playing around with what tax brackets you're in. This requires some significant planning in some cases.
So which one is the tax-free account?
Like your Roth IRAs or your Roth contributions to 401ks.
That's the other one.
Tax-free, yeah. So this is where we talk about how your specific situation could change some of those general rules. So again, there's just 4 general rules, and then these are some considerations. So if you have wealth, this is the biggest one, wealth transfer motives. So if you're a grandparent, you want to eventually leave some known amount to your kid or grandkid, you might not want to withdraw from your taxable account first, or you might not want to deplete it completely. And the reason for that is there's a very favorable item in the tax code where you get a step up in basis for inherited assets. So taxable accounts with built-in capital gains. So in that instance we talked about earlier, where if you're taking 50 out, you had a $10,000 basis, you paid tax on the 40. If you knew you wanted to leave 50 grand to your only child at death, you'd leave it in there because her basis won't be 10 when she inherits it, it's 50 and she pays no tax. This is obviously the easiest way to get rid of taxes. So this is where, financial planning, and we can help you out particularly, this is a very general presentation, but your specific situations, everyone's kind of different, and we'll talk through it every year. And this is where you can really start saving some money by planning now for what's going to happen to you in the future.
When you say it's like $10,000 in it, the unit grows to $50,000?
No, so let's say you had $10,000 today and you couldn't invest in it. You've maxed out your contributions to your retirement accounts. You just open a normal brokerage account, you have $10,000 in after-tax money, and you buy $10,000 worth of Apple stock. 50 years from now, that Apple stock's worth 100 grand. You'd pay tax on 90,000. So the basis is the 10 you originally bought it for. Okay, and this is what I'm saying. So if you wanted to give that Apple stock to your daughter when you passed, she doesn't pay tax on the 90. Whereas if you would withdraw it over time and depleted that portfolio, you'd have paid taxes on that 90 appreciation. So this is where, this is a perfect case where if you wanted to leave money to someone, general rule number 2, take from taxable first, doesn't work. So our conclusions are to diversify. You want to have, our general rule is to have 20%, at least 20% in each of the 3 types of accounts. You don't generally want to have less than that. Because at the end of the day, I showed you that slide where tax rates have gone down. At the end of the day, no one knows what tax rates are. If I could tell you what tax rates were, I'd have 1 million people in here listening to this presentation. So you don't know what unanticipated withdrawals you're going to have. You might have some medical problem in 1 year that you don't know is going to come, so you need a large amount. Might make sense to have a Roth account then to just take it out of that. So again, diversification amongst the 3 types of accounts is the key to lowering your overall tax rate. And you want to start doing it now because, as you can see on the next page, your contributions to IRAs and your tax-deferred and tax-free accounts are limited based on how much money you make and whether your spouse has retirement or you have employer retirement. So in our case with these traditional IRAs, you can do $5,500 if you're under 50. You get an additional $1,000 if you're over 50, called the catch-up contribution. And so if you have no employer retirement, you can contribute to an IRA no matter what. If your spouse has employer retirement and you're married, if your income's over 183, you start getting phased out. And if you're just single, and you have employer retirement, if your income's over 61, you get phased out. So this is why I'm saying it's better to start now, because obviously incomes, we hope, go up, as you get promoted and climb that corporate ladder. It's gonna be harder for you to kind of manipulate how much is in each 3 types of accounts. So it's better to start planning for this today. And it's even harder with what I called the retirement wildcard, which is actually an article on my blog. If you'd like to sign up for that, you can give me your email after the presentation. But as you see, the Roth contribution limits, if you're single, you're out after 116 grand. You can no longer, and this is the only way you can contribute to Roth accounts unless your employer allows for Roth contributions. So if you're married, it's 183 grand. So if you're making more than that, if you're 40 years old and you make well over that, you're out of luck for the tax-free accounts.
Wow.
Unless you do what's called the backdoor Roth. So this is a way to get around that issue. So if you exceed the limits, that we just discussed, there's a way you can do a backdoor Roth. And this is where you make non-deductible contributions to an IRA. So you know your income's over. Let's say you're married, you know your income's going to be 200 over the income limits to be able to contribute. You still can open up a traditional IRA, not a Roth IRA. You open up a traditional IRA, and you contribute the $5,500 to it, and it's called a non-deductible contribution because you know at the end of the year you're not going to be able to claim it as a deduction. So then, sometime during the year, before the tax year is over, you make a Roth conversion. So this is where you just convert that account to a Roth account, okay? And so Roth conversions are unlimited. There's no income limits on being able to do this. So this is a way you can get around those income limits. There's a big pitfall here. So if you have other IRA accounts, like a SEP IRA or other traditional IRAs, they kind of take it pro rata. So let's say you contributed $5,500 to a traditional IRA, but you had another 15 in a rollover IRA that was, tax deferred. When you do that conversion, they don't just assume you converted this. They take it pro rata from each, and you'll pay tax on the other account. So a way around that is you can check if your employer 401k allows roll-ins. So if you have this other rollover IRA or an IRA from a previous employer or a traditional IRA that you've already set up, it's going to hurt you when you convert it. You can try to roll that into your 401k. Then you only have the one traditional IRA for $5,500, and when you can convert it, you don't pay any tax. That's a way around it. Of course, you'll want to check if your 401k is a good one. I mean, generally it won't be worth it unless there's some good low-cost options in it, which again, we can help you evaluate that as well. But this is a big recommendation we provide to a lot of people, is to utilize these Roth accounts. Because no one, like I said, I like to see 20% at least in a Roth account. Very rarely do I see people with 20% of their retirement assets in Roth. It just doesn't happen. It's harder a lot of employers don't offer Roth contributions. People don't think to open Roth IRAs. This is a big recommendation we've had people do. These are just the sources from some of the slides previously. You can go, it's a very good white paper from Vanguard if you want to read more. They do actually, we didn't get into the nerdery of it, but they provide where they did all the research and the graphs and data. So if you want to go there, feel free. And that's it. It's pretty short and sweet. Thanks. Any questions?